Hello and welcome to the Market Mosaic, where every week we are taking a look at the intersection of macroeconomic data, market technicals, and market internals, things like breadth and sentiment to figure out where the stock market could be headed over the near term. And this week, let's just dive right into something more on the technical side of things, and that is with seasonality, more specifically how the S&P 500 is progressing during the Santa Claus rally period. Now, this period covers the final 5 day trading days of the year, along with the first 2 trading days of the new year. So we do have one more day to go for the Santa Claus rally period. And right now, we are down. And that is very significant because look back historically, going back to 1950, what tends to happen during the Santa Claus rally period, you can see there's lots of positive blue bars on here relative to the negative red bars. So this tends to be a very strong seasonal period, positive about over 75% of the time with a decent average gain. Now, here's what makes this year potentially so special if we end up with another negative return for the Santa Claus period. It's because you've had already back-to-back down years in 2023 and 2024. There's only been one other time in history that you have had back-to-back down years. But looking back, you have never had 3 consecutive down years in a row for the Santa Claus rally period. So we've got one more day for the S&P 500 to try and turn things around and prevent that unprecedented streak of 3 down years in a row from happening. All right, so while we're in this historically strong seasonal stretch, bigger picture, there's a lot more you need to focus on that's going to happen in the year ahead. And that's what I want to talk about I spend most of my time on this update today is talking about the things in 2026 that investors need to be on the lookout for. And that's because I believe there is a significant transition that could be underway in the stock market's overall trend. I have been very bullish for the last at least 18 months now. 18 months ago, I published a report in the Market Mosaic on Substack, and I recapped the catalyst behind that bullish stance. It included a rising liquidity cycle, a strong economy supporting the earnings outlook, and decade cycle seasonality. Years ended in 5 tend to be very strong. So we know that's now in the rear view, and I want to talk about my views ahead on what's going to happen. And I still expect a very favorable start to the year for the stock market. I believe the bull market will persist into the start of 2026 because of tailwinds like a growing economy. We had that third quarter GDP print that showed a really strong growth in the most recently available quarterly data. But the last time I looked at the Atlanta Fed's number, they're forecasting 3% GDP growth in the fourth quarter. So we're continuing to see strong economic data that supports the earnings outlook, and we're seeing ample liquidity supporting loose financial conditions. So loose financial conditions are a big tailwind, and those conditions are getting another boost from the Fed. So the Fed won't call this quantitative easing. They are stating that they're addressing funding constraints, funding strains in short-term lending markets, but whatever you want to call it, the Fed is back to expanding their balance sheet once again. So that's what this chart on here shows. It shows the assets held on the Fed's balance sheet. And for the last several years now, we've been in this regime of quantitative tightening. That is where the Fed allows Treasury securities held on its balance sheet to mature without reinvesting those proceeds. And so, that has the effect of shrinking the money supply when the Fed is allowing that to happen. And that is, as you can see on this chart over the past year, the effect of quantitative tightening has been to shrink the balance sheet. But look at what's happened just in the last couple of weeks. We've already started to significantly unwind the drawdown in the Fed's balance sheet just in the last couple of weeks. So keep a close eye on this. So the Fed's back to purchasing Treasury securities. That's injecting liquidity into the financial system. The result of that is that the Fed's total assets on the balance sheet is back to growing again. And that's just another factor that will help keep financial conditions loose, which is really great for the bull market. But I think later in the year, we could see a significant change in conditions. And as part of this transition period that could be looming For the stock market, I think all these factors driving loose financial conditions, especially the rising money supply, that will eventually force tighter monetary policy in the world's major economies. That would be a huge change from what we've seen over the past couple years. And I think you're seeing the warning signs of this. The rally in precious metals, the weak US dollar, these are warnings about what could happen later in 2026. Now, tighter financial conditions could be especially challenging because stock market valuations are very stretched right now. So this week, that's what I want to dive into further. I want to go into these charts and catalysts I believe will define 2026 and the things you can watch for to monitor if a major transition in the stock market's trend is underway, if we're starting to see this bull market on borrowed time. And so let's just jump right into it and just talk about the trend in financial conditions that we've seen. Again, financial conditions, loose conditions, tend to be supportive of equity prices, of stock prices. So that's been a major tailwind since the cyclical bull market started in late 2022. And so, the line you want to pay attention to on here is this brownish line. And again, this when it's above zero, that means conditions are loose. Below zero, it means conditions are more restrictive. And you can see the low found in financial conditions several years ago really coincided with around the start of the bull market that we're in. We've seen conditions swing back into loose territory and are now, near the loosest end of the range that we've tend to see going back over the last 30, 40 years or so. The other line on this chart, the black line on here, this is from the ISM. It's their gauge of manufacturing activity. This just shows how loose financial conditions correlate to expanding economic activity. When you look back, that's why stock prices respond well, because a growing economy means higher earnings. So conditions, they're at the loosest levels that they've been at since 2021. You can look back, that's why this remains supportive of economic activity in the stock market for now as we start the new year. Loose monetary policy and an expanding global supply. So, those are big drivers behind bullish financial condition. But here's the thing, this could come back to bite. If those conditions deliver stronger than expected economic growth, like we've seen in the most recent GDP report, inflation, a demand-driven inflation could become more problematic in the year ahead. So where are we at with inflation? Well, core measures of inflation, of consumer inflation, have remained near 3% on a year-over-year basis. We've had this disinflation trend since mid-2022. So just, inflation's positive, but at a decelerating rate. We've had the deflationary trend since mid-2022, but that's stalled out over the last couple of years. And we're still well above the Fed's 2% target. If we do see, an increasing money supply, loose financial conditions, if those things help drive inflation higher, then watch for inflation, consumer inflation, to repeat a trend that was seen in the 1970s, which happened in two distinct waves. So what this chart on here is doing is comparing CPI today, going back to 2014, that's the green line, and CPI from 1974 to 1982. And what you can see is that's the blue line. You can see the green line and the blue line are tracking very closely to one another, including the first inflation wave that you had into mid-2022. Here's the disinflation trend that's set in since then. But you've got inflation stalling out just like back then and starting to move higher. So this is something to watch into 2026. If the history repeats, if we see this cycle, this inflationary cycle continuing to track, you could see a major reacceleration in inflation in the years ahead. All right, here's another thing to watch for inflation, just really short term, is that this plots inflation expectations. So, surveying consumers in where they think inflation could fall ahead over the next year. So this plots the median 1 year ahead projection for a variety of call it commodity categories. These are things that are can be very, very impactful to headline inflation. Things like gas, food, but then medical care, college education, rents, and then gold in there as well for what I think gold will go. And here's what I want you to focus on, pay attention to with this chart. It goes back to 2014, but what I would look at is sort of this the rise in most of these series into mid 2022. That coincided with the last from 2020 into 2022. That coincided with the last big inflation wave. We've had these things kind of coming in since then. But look what's happened since the start of 2025. You've had all these data series, these median expectations for inflation across these categories inflecting higher. So keep a close eye on if those expectations becomes a self-fulfilling prophecy, and we see inflation start to inflect higher on a larger scale into this year. Now, here's why inflation matters a lot for stock market valuations. Stock market valuations are already running near historic extremes. The S&P 500's forward price to earnings ratio is at 22. That's 13% above its 30-year average, and it has only been higher during the internet bubble and the peak in late 2021 heading into 2022's bear market. So we're at those levels. Now, we've got optimism around the earnings outlook, and loose financial conditions can support those valuation multiples for now. But if we see rising inflation in 2026, that could really start to pressure valuations, because of these levels we're at now. It could be even more downside driven on valuation. So the chart on here plots the PE ratio. So PE ratio is on the vertical axis against levels of consumer inflation on the horizontal axis on here. When you get low levels of inflation, under 3 to 4%, this scatter plot, you don't really see a trend in here. There's not a correlation when inflation's at these levels to influence or drive what the PE ratio is. But look as inflation starts to rise. Now as CPI, as you move higher on CPI, you start to see a relationship emerge. It becomes more distinct. As the inflation number goes up, you tend to see the PE ratio tends to get lower. So that is why I'm saying you need to really keep a close eye on inflation in the year ahead. And if we start to see signs that inflation is inflecting higher, because really, once you start to get above 4 or 5% on CPI, you could really see that multiple come in. We're already running at a historically elevated level on the PE ratio. So that's leaving the stock market very vulnerable to rising inflation because of how extreme valuations are right now. All right, there's going to be some great trading opportunities, investing opportunities in the year ahead, outside of where you might have been looking last year. So stocks leveraged to the AI theme are obviously playing a major role in driving large cap indexes, both the returns, their gains, but their valuations as well. Not just, as an example, that the top 10 stocks by weight in the S&P 500 now comprise over 40% of the index. It's recently at a record level. It includes familiar names like Nvidia and Microsoft. But we have not seen stocks collectively, we have not seen stocks in the mid-small cap sector see a similar big jump in valuations. And so now what we're seeing is that mid and small caps are trading at historically cheap levels relative to large caps when you look at it on a relative valuation basis. So what this chart does is it takes the forward PE ratio of mid cap stocks relative to the S&P 500. So when this line is rising, that means mid cap valuations are getting more expensive relative to large caps. When the line is falling, that means mid cap valuations are becoming cheaper relative to small caps. And look at where we are now. We're at the lowest level since the late 1990s period. This was at the right around the internet bubble peak. And while most associate the internet bubble peak with some really bad times in the stock market, you did have really large drawdowns in the S&P 500 and the NASDAQ. Elsewhere, in mid and small cap style boxes, especially more on the value side, had some really terrific years in the early 2000s. And so that's worth keeping in mind as we're now at one of these valuation extremes favoring mid caps here once again. All right, so a lot of talk, a lot of attention around gold and silver. Really strong gains that we've seen, record levels on gold and silver into late last year. And it's getting everyone really excited, but you got to also take a step back and think about what are these moves telling us? And I think what it could be telling us is that the market is finally becoming concerned over rising U.S. debt levels and deficit spending. Corollary to that, the U.S. dollar index had a historically weak start to 2025 and finished the year with one of the worst annual declines in nearly a decade. So a falling US dollar, soaring precious metals, I think is worth monitoring given the massive amount of US Treasury securities that mature in 2026. So, what this chart on here is showing, it is showing if you look at all the US Treasury debt outstanding by maturity, what's the percent maturing by year, and look at 2026. 34% of all US Treasury debt outstanding will mature in 2026, or that's about $9 trillion in total. So that money, that debt wall has to be refinanced. But in addition to what debt needs, in addition to the debt that needs to be financed, there's an additional 1.7 trillion based on current forecasts, 1.7 trillion in new debt that must be issued as well. It's because we're continuing to run federal budget deficits, and to cover that deficit you need to borrow, and again those new borrowings just below $2 trillion. And so what does this mean? It means we need to be on the lookout for bond market volatility given the massive amount of debt that needs to be refinanced, new debt that's coming out. If investors start to get concerned and there's, call it, a buyer strike on purchasing treasury securities, you could see a lot of volatility in interest rates, and that could potentially spill over into the stock market here as well. All right, coming off a nice holiday break, and now we're going to get right back into it. We've got a busy week ahead for economic data, including some really key reports, and I just want to highlight a couple that I would keep an eye on. First up, I want to follow closely what's happening within these ISM PMI reports. So we've got the manufacturing PMI and then the non-manufacturing PMI as well. So this would cover the service sector of the economy. And we want to look for these headline numbers above 50. Over 50 means those the manufacturing or service sector of the economy is expanding. But within these reports, they're going to have things like new orders and prices paid. That's what I want to focus on. So new orders is a leading economic indicator. We want to see a recovery in new orders. At the same time, if we're concerned about inflation ahead, we want to closely follow the prices paid components. Those had spiked higher, following the trade war. They've started, in some instances, to come in recently. So we want to follow the trend in prices paid for some clues on the inflation outlook. But then lastly, we're going to wrap up the week with the non-farm payrolls report. And so, a lot of the recent reductions in the Fed funds rate, the Fed's cutting interest rates 3 meetings in a row. Powell has referred to them as risk management cuts. The Fed's getting a little worried about the labor market, and they want to start to ease policy a little bit to make sure weakness in the labor market doesn't get any worse. And so as a clue to how that's evolving, we need to keep a close eye on this payrolls report for the month of December and how that could influence monetary policy looking ahead. All right, we've got some really great chart setups developing, and one I want to highlight today is with Reddit, ticker RDDT. And the level I want to watch on here is really two levels to start. First, what I'm following on this chart is more of a base on base pattern. So this was the larger initial base that formed through several months last year. This looks like a cup of handles, so if this looks more like the handle area, and we had this breakout. I'm highlighting this area because that has become support now on this next basing structure. So we had a run up to around the 280 level at the peak before another pullback in Reddit in October. And a couple things I want to watch on here. First, again, this initial pullback held support at that handle breakout area. That's key. And what I want to watch right now is that we've had, a rally and not even a smaller pullback. I mean, it's really just been this sideways trading, which in a really tight range, which is a good sign of accumulation. We've had the stock price most recently starting to perk up a little bit. So there's two levels I want to watch. I want to watch what looks like this new handle area forming on here, and if we can get above the 250 level, from there you want to see a breakout to new highs over 280. So those are some levels to watch for a breakout on Reddit. All right, that is